Carol had done everything right. She spent 30 years maxing out her 401k, rolled it into a traditional IRA when she retired at 63, and had just over $800,000 sitting there growing tax-deferred. Then, a friend at her book club mentioned Roth conversions, and Carol went down a rabbit hole. 6 months later, she called a fee-only planner. She found out that if she did nothing, her required minimum distributions at age 73 would push her into the 32% federal tax bracket every single year for the rest of her life. Strategic Roth conversion, done over the next few years while she is still in the 22% bracket, would save her somewhere between $40,000 and $60,000 in total lifetime taxes. Conservative estimate. Nobody had told her this. Not the advisor who set up the original 401k. Not the broker who rolled it over. That is what today's episode is about. How you figure out whether a Roth conversion is the right move for your own situation. We will walk through 3 real cases, run the math in plain language, and finish with a short checklist you can work through tonight. 2 sentences so we are all on the same page. A Roth conversion means you move money from a traditional IRA or 401k, money where you have never paid tax, into a Roth IRA where it will grow and come out tax-free. When you do the conversion, you pay ordinary income tax on whatever amount you move in the year you move it. After that, the money is yours, tax-free, growth included, with no required minimum distribution ever. That is the whole mechanic. The only question is whether paying that tax now makes sense compared to paying more later. The answer comes down to 3 things. Your tax bracket now versus your projected bracket when you were taking money out. Whether you can pay the conversion tax with money outside the IRA rather than from the IRA itself. And whether you have heirs who will inherit the account at a higher tax rate than yours today. If you know those 3 numbers, you have most of your answer. Here is how they play out with real people. Before we meet our 3 cases, one idea makes all of them make sense: the conversion window. For many people, there is a stretch of years, often the early to mid-60s, when income drops. But the tax bill has not caught up yet. You have stopped working, so the paycheck is gone. You may not have started Social Security, and you are not yet 73, so required withdrawals have not begun. In those years, your taxable income can be unusually low, sometimes the lowest it will ever be for the rest of your retirement. That gap is the window. It is the cheapest time to move money out of a traditional IRA because you can convert dollars at a low bracket that would otherwise come out at a high bracket later, once Social Security and required withdrawals stack on top of each other. The window does not stay open forever. It usually narrows when you claim Social Security, and it closes hard at 73 when required distributions begin. So the people who fit most are the ones who notice the window early and convert a planned amount each year while it is open. Miss the window, and the same dollars get taxed later at a higher rate. Every case that follows is really a question about how wide that window is and whether it is worth using. Carol is 63. She has $800,000 in a traditional IRA. She collects Social Security, about $22,000 a year, and has a small pension from her state job that pays $14,000. Total income right now, before any IRA withdrawals, is $36,000. That puts her comfortably in the 22% federal bracket, as of 2026 rates. Verify at irs.gov because brackets adjust. Now look forward to age 73, when the IRS requires her to start withdrawing from that IRA. At a typical growth rate, her balance at 73 could be close to $1.2 million. Her required minimum distribution in year 1 would be $46,000 on top of Social Security and her pension. That combination puts her in the 32% bracket, possibly higher in laters as the balance keeps growing. Every dollar she converts today, while she is in the 22% bracket, saves her roughly 10 cents on every dollar. A $400,000 conversion spread over 5 or 6 years, that math adds up fast. The important detail: Carol has a taxable brokerage account with enough to cover the conversion tax each year. She pays the tax from there, not from the IRA. That is how the math stays positive. We will come back to why that matters. For Carol, the answer is yes. A phased Roth conversion, converting enough each year to fill the top of the 22% bracket without crossing into 24, makes clear sense. All figures as of 2026. Carol's situation is illustrative. Your numbers will differ, and a tax professional can run your specific case. Robert is 67. He retired 4 years ago. Has $400,000 in a traditional IRA. He collects Social Security at $28,000 a year, and his wife Diane has a pension that pays $30,000. Together, their income before any IRA withdrawal is $58,000. That puts them in the 22% bracket, but barely. Robert's problem is size. If he converts enough of his IRA to matter, say $100,000 in a year, his total income jumps to $158,000. That does not just push him into the 24% bracket. Because of the way Social Security becomes taxable at these income levels, his effective tax hit on the converted dollars is closer to 30% once you account for the ripple effect. There is another issue. Robert does not have much money outside his IRA. If he converts, he would have to pay the tax bill from the IRA itself. That erases much of the benefit, because he is shrinking the balance that would otherwise grow tax-free. Meanwhile, Robert's projected RMD at 73 on a $400,000 balance, growing at a modest 4%, is roughly $20,000 a year. That does not push him meaningfully above where he is today. There is no bracket gap worth exploiting. He is already in the 22 to 24% range. He would stay there through his RMD years, and he does not have outside cash to absorb the tax cleanly. The math does not work. For Robert, no conversion is the right call, at least not at any meaningful size, and that is fine. Linda and Tom are both 60. Tom retired early from engineering. Linda still works part-time. Together they earn about $90,000 a year, which keeps them in the 22% bracket after standard deductions. They have $1.2 million in Tom's traditional IRA. Their daughter is 35, a physician, and sits in the 37% federal bracket. Without a conversion, here is what happens when Tom and Linda pass away and their daughter inherits that IRA. The Secure Act 2.0 rules, as of 2026, require her to empty the account within 10 years. Verify at irs.gov for any changes. On $1.2 million plus 10 years of growth, she pays tax at her rate, which is 37%. That is a potential bill of several $100,000. If Tom and Linda convert a portion of the IRA over the next several years, say $200,000 a year, at their 22% rate, the money moves into a Roth IRA. Her daughter inherits the Roth. She still empties it in 10 years under current rules, but those withdrawals are tax-free. That rate gap, 22% today versus 37% on inheritance, is wide enough that even paying a meaningful tax bill now comes out well ahead for the family overall. Linda and Tom, this is as much an estate planning decision as a tax decision. The answer depends on what they want to leave behind. For most parents in this situation, the conversion done gradually makes sense. There's one error that shows up in all three cases and deserves its own section. Do not pay the conversion tax from the IRA itself. When you convert $100,000, you owe tax on it. If you use IRA money to write that check, meaning you convert $125,000 so that after tax you net $100,000, you have not really converted $100,000. You converted $100,000 and handed $25,000 straight to the IRS. The benefit of a Roth conversion comes from sheltering that money and its future growth permanently. If you shrink the converted balance to pay the tax, you are shrinking exactly what was supposed to compound tax-free for 20 or 30 years. Math works cleanly only when the tax comes from outside the retirement account, a brokerage account, a savings account, wherever. If that money is not there, that is itself a strong signal that now may not be the right time to convert. Here is a cost that surprises almost everyone, and it is the reason you convert carefully rather than all at once. If you are on Medicare, your monthly Part B and Part D premiums are not fixed. Above certain income levels, they step up, sometimes sharply. The surcharge is called IRMAA, the Income-Related Monthly Adjustment Amount. And here is the catch, it looks back 2 years. The income on this year's tax return sets your Medicare premium 2 years from now. A large Roth conversion adds to your income for the year. Push your income over one of the IRMAA thresholds, and you can trigger hundreds of dollars a month in higher Medicare premiums for both you and your spouse 2 years down the road. It is a cliff, not a ramp. $1 over a threshold can bump you an entire tier. This does not mean you avoid converting. It means you convert with the IRMAA thresholds in front of you, filling up to a line and stopping, the same way you fill a tax bracket and stop. Good analysis models the Medicare cost alongside the tax, because a conversion that looks smart on income tax alone can look different once the premium surcharge is counted. As of 2026, the IRMAA brackets are published at medicare.gov. Check them before you size a conversion. One more concept worth naming clearly, because it is what surprised Carol most. Required minimum distributions. The IRS mandated withdrawals that start at age 73 do not care whether you need the money. If your traditional IRA is large enough, the RMD will be large enough to push you into a higher bracket every year, whether you spend the money or not. You cannot avoid it. You can only reduce the balance subject to it. That is why phased Roth conversions in your early 60s, when income is often lower before RMDs start, can matter so much. You are draining the account that would eventually force large taxable withdrawals, and you are doing it at a lower rate than you would face later. Each year you convert reduces the future RMD pile. If your IRA is relatively small, under $300,000 or so, the RMD may never push you into a significantly higher bracket. That is Robert's situation. But if you have $700,000, $1 million, or more in a traditional IRA, the RMD math deserves a close look. As of 2026, the RMD tables are at irs.gov. That is where to model your own number. One more reason a conversion can pay off, and it is the one couples forget. Right now, if you are married, you file jointly, and the brackets are relatively generous. But when one spouse dies, the survivor usually moves to single filing the very next year. The income does not fall in half, but the brackets do get much tighter. Same retirement income that sat comfortably in a middle bracket for a couple can land the surviving spouse in a noticeably higher one, alone, at exactly the wrong time. Large traditional IRA makes this worse, because the required withdrawals keep coming, and now they are taxed at single rates. Converting some of that IRA to a Roth while both spouses are alive, and while the joint brackets still apply, can spare the survivor years of higher taxes later. Couples with a big traditional balance, especially where there is an age or health gap, this alone can justify a steady conversion plan. It is not a pleasant thing to model, but it is real money, and planning for it is a kindness. A short but important rule, because breaking it can turn a tax-free withdrawal into a taxed one. Each Roth conversion starts its own 5-year clock. Pull the converted amount out completely free of tax and penalty. 5 tax years generally have to pass, and separate 5-year rules can apply depending on your age and the type of Roth. Most retirees over 59.5 who are converting for the long term, this is not a problem, because they are not planning to touch the money soon anyway. If you are younger, or you think you might need that specific money within 5 years, the timing matters. Convert money you will not need for at least 5 years, and let it sit. Do not convert a sum you might have to spend next year. As with everything here, the rules have exceptions and they change, so confirm your own situation at irs.gov or with a tax professional before you rely on the timing. Before you do anything, work through these 4 questions. Question 1. What is your federal tax bracket today, and what bracket do you expect to be in when your RMD starts? If there is a meaningful gap, 2 brackets or more, that gap is worth examining closely. If the gap is small or reversed, conversion is harder to justify. Question 2. Do you have money outside your retirement accounts to cover the tax on a conversion? A brokerage account, a savings account, a CD that has matured? If yes, you can run the math cleanly. If no, you are likely shrinking the IRA to pay the tax, which reduces the benefit considerably. Question 3. Who inherits this account, and what is their likely tax rate? If your heirs will inherit at a rate meaningfully higher than yours today, conversion looks much better as an estate move, even if your own bracket situation is neutral. Question 4. Are you on Medicare, and how close is a conversion to the next IRMAA threshold? Size the conversion so a tax win does not quietly become a Medicare premium loss 2 years later. If you answer these and still feel uncertain, a fee-only financial planner or a CPA who works with retirees can run a Roth conversion analysis on your actual numbers in an afternoon. All figures in this episode reflect 2026 tax law. Brackets, RMD rules, and IRMAA thresholds can change, so verify at irs.gov and medicare.gov before making any move. Roth conversions are not magic, and they are not right for everyone. For Carol, the math is clear. Robert, no conversion is the right call. For Linda and Tom, it depends mostly on what they want to leave behind. The answer comes from your numbers, not from a general rule. People who get hurt are the ones who convert because they heard it was a good idea, paid the tax from the IRA itself, tripped an IRMAA threshold, and ended up with a smaller account and no lasting benefit. People who get it right find their conversion window, run the checklist first, and convert a planned amount each year with their eyes open. Run your numbers. Know you're on track. Leave a comment below with which case was most like your own situation. We read every one. See you in the next one.